Good evening, everybody. Thanks for sticking around for the Reabold presentation. It's about a year ago now that we launched the Reabold strategy. And we did that with a very specific strategy in mind, which was to fund other operators' high impact but very de-risked appraisal wells. And we're able to get into these projects at a very low entry point valuation, and therefore, in the event of success, generate extremely high returns for Reabold and its investors. Now, we've managed to raise just over £18 million in the last year, predominantly from institutional investors, and we've got exposure to a number of very exciting projects, and we're in the early stages of our drilling campaign at the moment, and Sachin will talk you through the projects in a little bit more detail later on. But I guess the key point to update you on since we last spoke to many of you is that we've had some operational success in the early part of that drilling campaign. We initially carried out 4 well workovers at our Monroe Swell asset in California. All 4 were successful and are now in production. And more excitingly, we drilled our first well at the West Brentwood field, also in California, and we're very pleased to say that was a success. Flow tests are significantly ahead of expectations, and that is being put on production as we speak. So far, so good, and the assets are delivering at least as well, or in fact better than we expected. So I want to just refresh everybody's memory, if they've seen this before, on the Reabold model and what makes it kind of different and what makes us unique and a bit differentiated. So we are focused very specifically on the appraisal part of the oil and gas asset life cycle. So we look at the asset life cycle and we see a value creation curve. And at the bottom of that curve is exploration. Now, exploration is extremely exciting, and when it works, it generates a huge amount of value. The problem with exploration for junior companies is it inevitably takes a lot of time, many years between starting to work on a project and actually getting to the point of a commercial project. And it also requires an uncertain amount of capital, which means companies have to keep coming back to investors in order to move their campaign forwards. And for both of those reasons, in a very difficult environment in the last few years, it's been very challenging for small junior companies to operate in that space. So we've kind of left that aside. At the top of the value creation curve, you've got production. So production is where you're trying to get every asset to ultimately. That's where an asset has to get to ultimately deliver value. And of course, as a management team, you love production because it generates cash. You get cash into your business and you can take that cash and do more things. The problem is when you try and buy into production, is production assets tend to be very efficiently and therefore fully valued. So you might get a strategic benefit out of buying a production asset, but the problem is, in our experience, companies very rarely generate positive returns on the capital they deploy buying a production asset. So we're focused on the very steep part of that value creation curve in between the two, which at the moment in the current environment, in our view, is the appraisal drilling part. And what we really target, our sweet spot, what we're ideally looking for, is what we describe as the last appraisal well, where you take a project that is already considerably de-risked from the exploration phase, but where we can still access at an extremely low entry point valuation, and with a very limited amount of activity, hopefully just that one well, we can move that asset right up the value curve very steeply, very dramatically, to where it's valued as a production asset. So that's the sweet spot in terms of generating returns on the capital that we invest into these projects. That's where we're looking to play. And I think that's played out so far in our West Brentwood asset in California, which I talked about before. So we managed to buy into that asset because it was in the pre-production phase at a very low valuation. That was just a couple of months ago that we completed that deal. We've drilled the well. We now have the producing asset, but we didn't have to pay for it up front. So that's the sweet spot that we're trying to play in, and as I said, so far that's working out as expected. A couple of other points about the Reabold model that I think are quite important to just emphasize. So the reason why we can get into these projects and why we can get into them very cheaply is they're stranded. And they're stranded because there's been a lack of available capital in the industry for pre-cash flow conventional assets for the last 5 or 6 years. So it's crucial that our capital and our involvement more broadly is sufficient to take those assets forward in a meaningful way. So that's the first thing that's very important in terms of our project selection. Another key part to our model, which is differentiated from most companies, is we have a very deliberate non-operating mentality. Not only are we not the operator of our assets, but we try and ensure that all of the project-specific technical, jurisdictional, operating expertise is kept outside of Reabold and is embedded in the partner or investee company. And we do that for a couple of reasons. Firstly, it keeps our own central G&A very low and means our cash can go into the ground and into drilling wells. But more importantly, it allows us to have, I guess, a very active portfolio management approach to the Reabold asset base. So by being able to tap into numerous sources of project-specific expertise, we can have a very diversified portfolio and drill lots of independent wells in different jurisdictions, in different geological settings, when we're running it with a very light central team. And even more importantly, it allows us to cleanly exit projects at the right time. So when we've got a project to move up the value creation curve and it's fully valued, we are minded to exit that project to find a form of monetization. And because the team goes with the project, we can cleanly exit and move on. And the fact that we think about exit right at the start, right at the onset of moving into a project, I think is an illustration of the philosophy that's different in Reabold than in a typical junior oil and gas company. And what I mean by that is that we do not see the accumulation of reserves or even the building up of a major production profile as the key metric to running an oil company, which is counter to everything you've been told by oil companies and the financial industry for a number of years. The metric that we use is cash in versus cash out. So for every dollar of cash that we put into a project, we are trying to maximize the dollars of cash that come back out. That's the only metric we ultimately use because that is the one that will ultimately lead to positive returns for our investors. Okay, so here's a quick summary of our current portfolio. You can see a number of assets in the UK, in Romania, and in California. As I said, Sachin will talk through these in a little bit more detail. But a couple of things to highlight. So firstly, the potential NPVs associated with these projects are all extremely meaningful in relation to the market cap of Reabold today. But also what's crucial is that these are all independent of each other. So what you get today as a Reabold investor, you get access to a portfolio of multiple, fully funded, independent, potentially transformational drilling events. It's also worth pointing out that we have a significant amount of firepower on the balance sheet beyond this, so we will be adding more projects to this table in the not too distant future. And this is really the same thing, but with a timeline associated with it. So as you can see, we're at the early stages of a very intense period of drilling. By the time we finish one well, it feels we're almost into the next one straight away, which is exactly how we set it up to be. Again, we will be adding additional projects to this chart in the not too distant future. And what we're really pleased about, of course, is that the first two have been successful, and we're very happy to be able to update you to the fact that we have successful workover wells, and our first drilling event was also successful. And of course, we have a number more to come over the next few months. And with that, I'll hand over to Sachin to talk about the assets in more detail.
Thanks very much, Steve. Can you hear me okay? Yeah. Okay. Thank you. Right, so what we're going to run through now is essentially a series of projects which highlights and exemplifies everything that Steve talked about. And just to reiterate it again, we're talking about projects with low technical risk, where drilling is in the near term, the pathway to monetization happens soon after drilling success, and the return characteristics of the opportunity generate very substantial return for Reabold and their investors. Okay? So each of those is going to be highlighted in the projects we talk about here. So the first area we're going to reflect on is in California. So Reabold, California is actually made up of 3 different project areas. Furthest to the north, you have Grizzly Island, West Brentwood in the middle, and then Monroe Swell at the end. Right? The program here is to drill a number of wells across all of those areas to earn in. And what we've carried out so far is the initial activity of a well workover program and the first successful well that we've drilled. So 4 wells were successfully worked over, and you have what the NPV is up to $10 million for that 4-well workover program. And we announced that all 4 wells successfully delivered production, which totals 70 barrels a day gross. Bear in mind the amount of capital that was applied to this is very low, and we generate substantial netbacks within California. Then the next well that we drilled was the VG3 well, which you see in the lower panel on the slide over here. And what you're looking at is the depth structure map. And really the reason why this became low technical risk is we had a number of offset wells that were already in production that did start to water out later on in their lives. The 3D seismic data demonstrated where the up-dip location was, and that's where you see the VG3 well. Combined with the historic data we had here, the technical risk did indeed turn out to be very low. So that data, the historic wells, as I said, lent this low technical risk nature that had been overlooked by the industry, and we were able to put it in production in short order. We're talking about facilities that will provide 200 barrels a day, or more than 200 barrels a day of production, which was, I think it would be fair to say, above expectations. Sorry. And I should say, Grizzly Island is a gas opportunity, and that will be amongst the wells we will be drilling later this year. Munro's Swell, which is in the top panel, is located where the well workovers took place. Again, the well workovers not only deliver cash, but de-risk the underlying next well that we will be drilling there, and the 3D seismic data located in the central cluster where the yellow is, combined with those wells combined with the 3D seismic data, again, really are just a replication of what we did in West Brentwood. The next well that takes place in Q4 of this year is the Wick well, which is in the Inner Moray Firth in Scotland. Lowish technical risk here because the 3D seismic data combined with the Libster discovery that was made in the up-dip location allows this opportunity to be not only exciting, but have this clear pathway to monetization because the Libster discovery is already there. Corallian will be drilling this at a 40% interest, and just as a reminder, we own approximately 30% of Corallian, the operator of this opportunity. The other well in the Corallian portfolio also to be drilled in Q4 of this year is Coulter. And Coulter fits into the profile that we talked about because it's just south of Witch Farm. BP drilled a number of discovery wells on the Coulter location, and the reprocessed 3D seismic data along with this historic wells, amongst other changes that took place in this license area or in this basin, meant that Coulter is now a very attractive low-cost opportunity, and the pathway to monetization being clear because we know that Witch Farm is a field that has been in production for a long period of time with multiple wells that have been drilled on there. It's 480 million barrels that will ultimately be recovered from here, so there's a deep knowledge and understanding that takes place in this region. Coulter, along with everything else we've said, clearly also has a very high impact to the Reabold investor. This chart over here just displays some of the characteristics of the economics associated with the field. We talk about the projects as being high return, but we also mean that they have to demonstrate really high quality. And the high quality effectively comes through with extremely low break-even. So, we had a question earlier, what about the oil price? Because we can buy into the project so cheaply and they are so robust, they work down to an economic break-even at very low oil prices, and in this case, down to $18 per barrel. And that's an economic return, I should stress. The final project area that will be taking place, where drilling will be taking place late this year, early next year, is in Romania. So we set up a company called Danube Petroleum, into which the Parta license went. And Parta has a discovery that was made on it on the Ichia Mare location, where the red arrow points to the very northern part of that field. It was a gas discovery that was made, and it tested for gas. There was another gas well that was drilled there that actually flared gas. And again, it is a situation at the time when there was no gas market. Subsequent 3D seismic data clearly demonstrated the further potential on the license area, and therefore is amongst the lowest technical risk opportunities we have. But unlike some of the other opportunities we have, this has substantial running room beyond the first two wells. And that's a very important part of the growth of monetization of this underlying asset. The table, the words over here really describe the characteristics in terms of numbers. It's a reasonable size field with extremely high impact NPVs associated with them, but please bear in mind what we were also referring to, which is the running room on this license area. The return characteristics are extremely high because of the very robust gas price that exists in Eastern Europe that is now converged with Western European prices. And that convergence exists because infrastructure links those two markets together now. So that's a summary of the very exciting campaign that we have built up just in a year to have these 6 wells, 2 of which have already, this activity, the first 2 parts of which were very successful already. But we're not satisfied to stop there. While the market dislocation exists, there is an opportunity to carry on rolling this strategy out, because, to stress again, low technical risk opportunities with high returns can still be bought into at extremely low valuations. And while that persists, there is an opportunity for Reabold to carry on building this portfolio for the benefit of its investors. We should also say, soon after the last raise had taken place, we also consolidated and increased the capability of our board. The first name you have there is Marcus Mazetic, and Marcus Mazetic established Repsol's global exploration department, which he headed. And that department, as I said, that he was responsible for heading, really led to some of the most remarkable discoveries that were made in the industry. And these were most notably in the Brazilian pre-salt plays, where you had discoveries like Carioca, Pau de Sur, Gavia, Sayat, and the like, that were the envy of the industry and led Repsol to having some of the most attractive reserve replacements in the industry, having been at the lowest end of the table of the super majors. So Marcos, having achieved all of these, the Spanish super major Repsol, we are delighted to now be bringing him on board with Reabold post his retirement from Repsol. We also have Mike Felton joining the board, and he was a fund manager at M&G and ISIS prior to that. And he brings the capital market and financial expertise that is really needed, not only for our interaction with the very substantial shareholder base that we've built up of institutions, but also the financial rigor associated with the investments that we will be making in the future. Finally, we have Peter Dolan, who carries on being an advisor to the company, and he's been with us for a very long time, both as Reabold and a personal friend to Stephen and myself, but has really supported us because he sees the tenacity of the strategy that we were deploying. He is known for the very substantial success at Afir Energy, and prior to that, Fusion Oil and Gas, and was recognized as the Africa oil legend for the numerous discoveries that he made as an entrepreneur and geo in the discipline. So in summary, to almost reiterate everything we've said again, this is about exploiting a market dislocation that exists, low technical risk opportunities, near-term drilling that can be monetized soon after successive drilling with extremely high returns for their investors. We like to think what you've gone through, what we've shown you today, is a demonstration of the execution of that strategy, but it doesn't stop there, because this innovative model can be rolled out further in the current market conditions to allow us to capitalize on future opportunities. We have substantial institutional support on our shareholder register, as I alluded to earlier, that really allows for the platform of growth for substantial capital raises for future opportunities that will only take place, obviously, we think, at much higher share prices than where we are today, but also to capitalize on the larger opportunities that currently exist out there for us to roll this strategy out. But I should also highlight a point that Stephen made earlier. We keep everything lean at the corporate level, because when the right time to exit is evident, we need to be able to do that without any baggage at the corporate level. That's really important for how we've set this up. And that trade-off and that decision-making is something we are always and constantly evaluating. So with that, I'd like to thank everybody for their time.
Thank you.
Questions?
Do we have any questions at all?
Thank you. In your opinion, how long will this market dislocation last? Your market cap, what, roughly $40 million versus the NPV of what, closer to 400? The market clearly is mispricing your assets. And how do you think about this mispricing kind of being unwound over time? How do you see that happening over what period?
Yeah, I mean, there's sort of a couple of questions in there. So firstly, the fact that we consider our share price to be unrepresentative of our asset value is sort of inevitable when you think about the background behind the whole strategy, which is that the market is not valuing these assets properly, right? So what we have done is make sure that we have picked up assets where we think there is a very visible and ready path to monetization. And that's entirely about the way that we solve that dislocation between the investor appreciation of the assets and what they're really worth. So in California, for example, we just put the things into production, we generate cash flow. In the case of the UK opportunities, we think there will be a very ready asset market for those in the event of success. So that's how you close the gap. You ultimately turn your assets into cash, and that cash will be substantially above where the market cap is today. So that's how we go about closing it in an environment where the market is not recognizing the value of the assets. Now, there's another part to the question, I think, which is how long does that dislocation last more broadly across the industry? We don't know, is the simple answer. We're starting to sense it might be starting to close, given commodity prices are going higher. Oil companies, larger ones with producing assets, are getting more flush with cash. Balance sheets look better. They're starting to filter that cash down into smaller scale investment opportunities. So it may be the case that this closes and asset price inflation takes place across the board. In which case, to Sachin's point he just made, we're in a position where we can exit all of our assets and wind everything up.
Any more questions? I'll give him two quick questions. Well, first quick question. What's the oil price you're achieving in California? And the second question, I guess, follows on from the gentleman's question at the front regarding also window of opportunity. What sort of, I suppose you talk about the slightly larger assets, etc. What sort of jump do you see the current portfolio you've got at the moment is very impressive? What sort of jump up into that next sort of tier do you see, sort of quantification of size you're talking about when you could actually sort of go again but with a slightly larger set of investments?
Yeah, the oil price that's been achieved so far in California is about $75. So we're at a slight discount to Brent, but a notable premium to WTI. I mean, given recent last few days, that'll be going higher, but that was what we sold at most recently. In terms of the jump in scale, I mean, there are opportunities at all scales in the oil and gas space, that's clear, but we are very mindful about the portfolio impact. So even if we had the capital available, there's no way we'd go and take a punt on one well that costs $30 million because that just swamps everything else and suddenly you become a binary bet again. So in terms of scaling this up, it has to be done in a sort of progressive fashion because we've always got an eye on having the right shape of the portfolio, if that answers the question.
And just a final point, Matt, I think you've probably seen the equity exposures that we have are between 30 and 50% associated with each of the projects. The capital of that percentage has got to be sufficient to allow the well to be funded, is fully funded for drilling. So, that's the other element that we think about associated with the capital that we're deploying into the underlying project.
What I was trying to allude to before you started was obviously the fact that you've delivered on everything you said you would do, and you seem to have got a very good following from the institutional market. I mean, do you see that continuing, and obviously that support just growing elsewhere?
No, I think everybody's lost their faith in us.
Good.
I'm only joking, of course. The guide that I use to that is when I first met Ben Turner, who never smiled once when he saw me, but now every time he sees me, he smiles. So
it does.
we must be doing something
It does.
right. But in all honesty, just to answer the question associated with where the institutional investors are on this, you have to bear in mind that 13.8 was it that that we had raised came over its various stages of our life cycle. Every institutional investor that saw us essentially saw us, waited for us to deliver, and then came in. Every time we go back to them, we are saying the same story, and we're ticking off another box on the commitments that we made to them at the start. You do that the third time, it is almost impossible for them not to invest with you. And that's where we want to get to, and that's where I think we've got to now. So that support is there, and we believe it is there to take us to the next stage of growth at the right time.
Any more questions at all?
Thank you. It's not so much a question, it's just a vote of thank you. I think you're doing a fantastic job, and I'd like everybody to put hands together.
Thank you very much.